You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Sean Brodrick, natural resource specialist at the Oxford Club. His website, InvestmentU.com. Welcome to the show, Sean.
Thanks very much for having me on.
Everybody's watching the price of crude, and with Iran now joining the production crew, prices today below $30, down to $28 at some times.
Actually, in the U.S., they were actually below 28. They were 27 something. So, yeah, it's a thing that's really shocked the market. In fact, we have seen prices in the stock market sell off, and I think one reason for that, I mean, sure, energy stocks are leading the way down, but I think people have to be scared who's going to be on the hook for all of the energy company debt, which is a tremendous amount. I mean, they piled up the debt to expand over the last few years, and then suddenly the bottom fell out of the oil market. So they have to think there are probably some big banks who are really on the hook for that. And so we'll have to see how that plays out. Do we know who owes what to who? No, I've been kind of looking around at that. There's a few banks who, they have 3 to 5% of the loans are in some way connected to energy, but I haven't seen any big fish yet. I mean, ones who have a really unmanageable portfolio, but just because I haven't seen it doesn't mean that it isn't out there yet. And we could be surprised by that bad news rather quickly. That is one thing that I would keep my eye on.
Well, Royal Shell just announced that they're going to lay off 10,000 workers. That can't be a good sign in the energy sector. Yeah, that's a shame, too. Those are good jobs. You can't really replace those with people who are, working at, restaurants, that kind of thing. That's just not comparable. That said, I expect this year to be a real turnaround year. I was thinking the second half of the year is when we'd see things really bottom. Goldman Sachs, though, just came out with an interesting note, and they have been kind of right so far. I know that it's really fashionable to hate Goldman Sachs, but they expect the price of oil to really bottom in March, and that's sooner than their last projection on this. I think that things have really unraveled in the oil sector faster than just about anybody thought possible. If they're right, and of course it's a big if, we always have to say that with a qualifier, then, that would be great. That would probably save some companies who would otherwise hurtle into the abyss. Because what we need now is we need some companies to shut down. The rest, right size, recapitalize, stuff like that, and get rid of the things that aren't working for them now. And the sooner that happens, the sooner we go through the big pain of ripping off that Band-Aid, then I think the much better the whole industry will actually be. The stock markets, the Dow lost 10% in 10 days with a bit of a rally at the end of the day to keep them from that 10 days of 10% loss. But still, a 10% correction to start off the year, that doesn't help people, does it? Yeah, it was actually the worst start to the markets ever. The first 2 weeks of the year was the worst first 2 weeks of the year they've had in U.S. market history. So, that's not good. Why is that happening? One is earnings. Earnings expectations are heading lower. And so as they head lower, people say, this isn't going to help these stocks, so they sell. But that's really been amplified by what's going on in China, in the oil markets. There is chaos around the world. And so that's really turned it into a selling panic. The good thing about a selling panic is they tend to be over more quickly than not. And also, there's a great study that I put on my Facebook page, actually, not to plug that, but just explaining what my actual, line of thought is here, that by the time the market realizes it is in a bear market, most of the damage is usually done if it's an average bear market. And so I think people might really be really worried here. And if you aren't positioned properly, yeah, you could still worry some. But as long as you're in quality stocks, and especially those that will rebound once the turn comes, I don't think there's any real reason to panic. You should have panicked early. There's an old saying in the markets,
if you're going to panic early, right? And so if you didn't panic, you might just want to raise a little cash, sell some things you know aren't really going to work anyway, but just keep that cash on hand because the time to buy will be coming sooner rather than later.
And of course, there's we know the saying "sell high, buy low," but going into this situation, people were still buying overpriced stocks like crazy.
Well, yeah, but the thing is, there's been a real change in the whole psychology of the market, and that's hard to see coming. So I don't blame anybody for buying anything, frankly. Things had worked quite nicely for years. We all got fat and lazy because, we've had this really nifty bull market in which it's not hard to look smart. 2015 was tough. The market really just kind of went sideways except for the market leaders. And if you move down into the small caps, they got hammered in 2015. An absolute massacre. Small caps, micro caps even worse. And anybody who owns gold stocks knows what I'm talking about. Funny thing there, though, is that now we're seeing the price of gold start to move higher and look good. Now, a big part of this is, of course, people are worried about the global markets, and certainly gold is a store of safety, and so it's a place where people will hide out. There are other forces at work as well, though. One of those is it seems like global gold production really peaked in 2015. That's what all the data seems to be showing us right now. And GFMS and the other big names are looking for a drop in production of at least 3% this year. That's what they're expecting. Why is that going to happen? Because people haven't been investing in new mines for the last 3 years. Why the heck would they, right? And also, the CEO of Randgold just came out on Friday and said at recent prices, half of the world's gold production doesn't work on a cost basis. What does that tell you? More stuff is going to have to shut down. So you can see why that decline of 3% in production is probably going to happen. So we'll have less supply. On the other hand, China is buying more gold. We're seeing consumers really start to pick it up there. The central bank there is also buying. Part of this is related to the fact that our currency is in a slide, and so if your currency is sliding, that causes automatic inflation, right? Because your money's worthless. And one way to protect yourself is to actually purchase gold. So I think that's what's going on in China now. So my whole point there is that there are some good things happening in gold since we've had a 3-year horrible market in gold. I think a lot of people aren't really aware of them, but nonetheless, those changing fundamentals are there. We haven't really seen it reflected in the gold miners yet. I think that's because many investors don't believe what they're seeing in gold. And I can't blame them because, again, 3 years of brutal selling, that really will make you think twice before you pick up anything. And one can only have so many burned fingers. I think there might be an opportunity in gold this year. It might not be here yet, but it's certainly something to keep in mind simply because of the action we're seeing in the metal that we haven't seen reflected in the stocks themselves yet.
I wonder, are some of the healthier gold producers stockpiling right now, anticipating higher prices?
Well, yes. We have seen some produce more than they actually sold in the last quarter. I can't think of any particular names right now, but I kept seeing that in reports. Probably because, these smart guys running the mine said, this can't last. We might be a low-cost producer, but we know other mines are really going to be in trouble. And so they just decided to stockpile. We did see some of that happen. Now, of course, that's a problem. If the price goes up, then they'll say, well, we hung on to it, now let's sell that stuff. That could temporarily increase supply. Really, we need things to really balance out in these markets. But again, after a multi-year bear market in gold, which is what we've had, the investment in that area has really, really declined. And it's a natural cycle. If you aren't investing in new mines, what's going to happen is you're going to have eventually a lack of supply somewhere in there.
Well, I wonder about zinc prices because the 3 biggest zinc mines in the world are shutting down.
Here's the thing. Industrial metals seem to be more related to China's economy than precious metals. There's a bunch of reasons for that, but basically when China was doing the big, huge, massive construction all across the country, that was using a lot of all those like metals. Now there's less construction, and their economy is really slowing down. I am not saying their economy is actually contracting. It's just growing at a much slower pace. And so there's a lot of things going on there that could weigh on the industrial metals for some time to come. We haven't seen the kind of bullish action in that we have in, like, precious metals. So I wouldn't be too quick to pick things up there. You know, that said, I own a miner that produces both zinc and silver. I'd love to see that rally, but I'm just not as, like, really positive on that right now as I am on things that should happen in gold, because we are seeing the price of gold move, and eventually that should be reflected in, like, those miners. And even though there have been things going on in things like zinc and copper where mines have shut down, that hasn't really been reflected in the price action of the metals yet.
And I'm wondering, too, with the price of oil, Iran apparently had oil tankers stationed off the refineries in China waiting for yesterday's lifting of the sanctions. That's not going to help immediate prices for oil, is it?
Well, I think that's actually part of what we've seen this week so far, is people just really, worried about that, because the sanctions on that they had related to their nuclear program, right? Those are the ones that really blocked Iranian oil for quite some time. Those lifted on Saturday. So this early week carnage we've been seeing is related to both anticipation of that stuff coming on and probably some of their oil being sold into the market now. The Iranians would be fools to sell it all at once. That just wouldn't work for them. It wouldn't work for anyone. And frankly, I don't think they could. I don't think there's the storage capacity. We know a lot of storage capacity was filled up over the course of last year, and sure, the Chinese are building a lot more storage capacity. In fact, now they're talking about building new underground storage capacity, which means they'll probably get to enjoy oil leaking into their water supply along with everything else, because we know safety first in China. But so I think that the thing with the oil from Iran, the initial surge, is actually happening right now. It'll probably play out over quite some time, because again, you can't sell all that oil all at once. But it's actually happening now. That's one of the pressures on the price of oil right now. And here's an interesting point, by the way. The first U.S. tanker, the first tanker of U.S. oil, produced in U.S. oil and exported under the lifting of our own ban, unlike our own oil being exported that just arrived in Europe. So the rules of the game in oil are changing. There's a lot of stuff going on all over the place, and so it's going to be an extremely volatile time. Goldman Sachs expects oil to hit its new bottom in March. I'm not going to try and pick that, because I don't know when oil is actually going to bottom. I thought it probably would have found some support at 30. That was actually what I was thinking. Obviously, I was wrong on that one. And so we'll just have to see how low it goes. That said, there are good companies that can ride this out. We have a couple of them already recommended. Yeah, they're down, but they pay nice dividends. You're paid to wait. And when the rebound comes, these things will rebound like Wilt Chamberlain in his heyday. It's just going to be great. So I'm not worried about those. They'll be all right, and we'll just ride it out. I think people have to stop panicking. That's a good thing for individuals not to do anyway. Don't panic. But the market has to stop panicking so that we can look around and see at all these bargains that are just waiting to be picked up once people realize that the market's going to reach some kind of new normal. I'm not exactly sure what that is, but it will be a new normal, something we can all adjust to. One thing to keep in mind is with prices this low, and I'm looking at 26.55 for the NYMEX right now, then with prices this low, we'll probably see more shale oil producers shut down, the high-cost ones, because they just can't operate below 30. As much as the new tech is lowering costs, it can't lower them fast enough for some of those guys. So we'll see more oil shut down. And so they were initially expecting a loss of 500,000 barrels per day by midsummer. It'll probably be more than that. Probably be more than that here in North America, simply because the price is so low. Now, if Goldman Sachs is right and we find a bottom in March, things will head up again, and then we'll see some new production come back on. But I expect extreme volatility, price swings like you wouldn't believe. There are ways to play this, but one of the smarter ones, if you want to go long, is to go long in something that pays a nice dividend and can support that dividend at the current cash flows it has. Don't get too greedy and just ride it out, because when these things take off, when the market realizes that there are real bargains out there, then you'll just want to be long at that point.
The companies that have never really disappointed over the decades.
Yeah, I don't think you really need to get really speculative right now looking at, say, an oil services company, because those have been flattened by a steamroller, right? And so if you're a real speculator, yeah, you could look at that kind of stuff, but why bother? There are great producing oil companies with nice fat dividends that can support those dividends that are dirt cheap right now. If I had to buy something, that is the thing that I would be buying. I would not be buying speculative plays simply because you don't have to. Then again, if you have more mad money than you know what to do with, go to town. It's just realize there are other ways you can make money in this market. Here's a way that I bet a lot of people haven't thought of, is that the U.S. consumer, simply because of the fall in the price of gasoline year over year, so far is saving $17 billion a year. So what's that going to do for consumer spending? Probably going to juice it up. Probably going to see a lot more spending on all kinds of consumer stuff. Now, a lot of it will be at, like, the gas station. They'll be buying more beer and cigarettes. That's probably sure. But there's other stuff that can do well also. And so there are ways to make money in this oil market. You just have to be a little more creative.
Sean, one thing I was wondering with the people keeping their money, if they have lost their high-paying oil patch job and replaced it with working in a restaurant, will that savings really be realized?
Well, that is a problem. You know, I mean, I certainly have sympathy for anyone who loses a high-paying job in the oil patch, and I hope that they land on their feet. Some of those jobs will come back once everyone stops panicking, and so there is a bright side to that. However, I do think consumer spending is what's really going to prevent the U.S. from sliding into recession. We have a strong dollar. It's probably going to remain strong at least through the first half of the year. And so people will tend to feel rich. And so that is probably how that's actually going to work out.
Sean, thanks a lot for chatting with us.
Hey, it's always a pleasure. Thank you very much.
My guest has been Sean Brodrick, Natural Resource Specialist at the Oxford Club. His website, investmentu.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.